And where does it leave the Monetary Authority of Singapore? They will reset to the midpoint of the nominal effective exchange rate, it says just in comments just out, because there is an expectation that they will steepen the slope in the October 2022 review. Are they going to stand down on that, Vish, considering what has been happening or what is happening now in the global environment and the risks?
I think, insofar as the MAS is concerned, their view is really one of stable and sustainable economic growth 3 to 5 years out, and not just the imminent headwinds. So inflation risks will certainly be tackled, and what gives them a lot more bandwidth here and flexibility here is the fact that they've done a lot more tightening upfront. We had the recentering back in April, and they started last year in October. And we also bear in mind that Singapore is a price taker on global interest rates. So rising US interest rates will also help to cool demand in Singapore. So that does not box the MAS in any place. But we still think that in October, regardless of growing recession risks, the pace of the trade-weighted Singapore dollar appreciation, the slope of the Singnia, in other words, will be steepened further to rein in longer-term inflation expectations that continue to be battered by higher prices.
Vishnu, this is JP Ong. Staying with the MAS actually, and they have a bit of a catch-22 question here. On one hand, if you ease the pace at which they tighten or raise the slope on the Singapore dollar, which is their main monetary policy tool, it might actually help support the economy grow. But a weaker Singapore dollar, especially in a country that imports almost everything, well, that leaves you more susceptible actually to inflationary pressures. What do you think is the more important thing for them to address at the moment? Maintaining this economic growth or this recovery that we're seeing? Or is it really just making sure that the average Singaporean, via the Singapore dollar, will get more bang for their buck and perhaps weather some of these inflationary storms that we're seeing and uncertainty at that as well?
I think you framed that trade-off perfectly. And under current circumstances, the MAS will first and foremost tackle inflation expectations, the risks to which continue to be rather elevated, and so they don't want expectations to get unmoored. And for that reason, they will continue to incline the Sing dollar towards more, not less, appreciation bias. Whereas in terms of the exports, from the exports point of view, there is no compelling reason to try to get the Singapore dollar to be competitive on that front, because I think productivity growth and the overall global demand is what Singapore banks on to drive its exports, whereas Singapore dollar is after stability, and in this case, checking inflation risks.